from Georgia, 5 minutes.
Thank you, Madam Chair. Ms. Bair, in a meeting I had 2 weeks ago with your staff, they informed me that it's unlikely that the FDIC will wind down the use of loss share agreements in Georgia. Setting aside my strenuous objection to this, I have serious concerns about the loss share agreements that will begin to mature in 2 years. As the stop date of a loss share agreement approaches, I have serious concerns that the banks with these agreements will begin to rapidly sell off assets to take advantage of the agreement. This could lead to yet another downturn in real estate and make it harder for people to obtain loans. What is the FDIC's plan for these maturities of loss share agreements?
Well, Congressman, I think the maturities, I'm not sure where you got this 2-year figure. The maturities of the loss share coincide with the maturities of the loan. Now, there are estimates about when they will expire based on what we expect the maturity of the portfolio that's subject to loss share is, but there is no cutoff point where there's no longer any loss share and it's going to get dumped on the market. That is not how it works. Actually, we think that the loss share prevented a lot of property going onto the market because it facilitated our ability to sell the whole bank, both the deposits and the assets, to another insured depository institution. If we had not provided loss share, we would have had to, bank probably wouldn't have taken the assets, we would have had to sell it on the open market at extreme liquidation discounts, or hold it ourselves and manage it, which is inefficient and costly and difficult. So actually, I think the loss share has helped keep a lot of assets in the hands of other better capitalized, stronger depository institutions. It's kept the property off the market. And the loss share agreements also, I want to emphasize, we have very stringent rules in loss share agreements about loss mitigation. And if a loan restructuring will have greater value than a foreclosure, we want the loan restructured. We have very specific rules about that. And if we audit that, and if they don't do that, they can lose their loss share payment.
Y'all might want to send some folks out with your regulators that actually go out and do the work in the field and see where the disconnect is.
I would. I do
certainly
hear this, and again, if you have specific examples, we would love to hear them.
Well, you know, the problem with giving examples is these banks are afraid to death of retaliation.
Yeah.
And so we'd be glad to give you examples, you know, but trying to get some of these guys to come forward, I've been trying to do it for a long time now, and I'm being serious. They're definitely afraid of retaliation. And, you know, I mean, it's really, if y'all think the loss share agreements are helping,
right,
then that could be the problem.
Right.
Because they're not. But let me, before, and I don't want to cut you off, but I do want to ask you one question. Despite the occasional lip service that some of these regulators give for talking about they want these community banks to continue to be able to provide service to small business and local customer, the examiners continue to second-guess bank management policies and downgrade loans based not on the current status of the loan. In other words, some of these loans are performing loans, but based on a scenario where there is no economic recovery. And virtually every examination ends with significant downgrades not supported by professional outside loan review or by independent accountants. If the FDIC is serious about allowing banks to serve their customers, why are the banks being second-guessed on even the best documented loans? And I don't understand how a bank can get all A's on a report card and 6 months later get all F's and do everything but call the board member crooks.
Well, again, it's hard to respond without knowing what the facts may be in the individual case. I would say that we do not, as I said before, if the loan is performing, if the borrower has the capacity to continue to perform, it's a good loan. Even the collateral's gone down. Even if it needs to be refinanced, it's a good loan. If you have examples, I do want to know about them. I will personally assure the banker that there will not be any retribution by bringing this to our attention. So I really don't know what else I can say. I mean, I think examiners do need to exercise independent judgment. Bank management, they need to listen to bank management, understand their reasoning, but bank managers are not always right. And there have been some big mistakes. And I think we are hopefully for the most part through this, but early in this crisis we did have a lot of very dramatic downgrades from banks that had very
Well-
good supervisory ratings to ones that went to troubled status. And for that reason, we are putting more of an emphasis on what we call forward-looking camels and asking banks to stress their portfolios and stress conditions. But that's just from a risk management perspective. That doesn't mean if the economy tanks unexpectedly that they have to start holding more capital now. No, we just want them to be prepared and think through all the scenarios.
And listen, I appreciate those comments, but I really hope that some of your senior management or whatever can go into some of these banks. And as my colleague
Well,
from Georgia mentioned, you know, we have a tremendous amount of them that's either on a consent order, cease and desist on the problem bank list, that's still to come. And this is sucking wealth out of these communities. And the loss share agreement and the immediate write down is doing a reverse situation on our local economies. It's killing us. We need some help. And thank you, Madam Chair, for your generosity.
If I could just indulge the chair, I'm actually going to be in Atlanta soon. I'll go one further. I'm happy to meet with, we'll go to your district and meet with a group of bankers personally, if that would be helpful to you.
Well, I may take you up on that.
Okay, great, thanks.
Mr. Carney from Delaware.